All right, let's talk about a number on the balance sheet that trips up a lot of investors. Retained earnings. Now, on the surface, it sounds great, right? A company is saving its money. But is that always a good thing for you, the shareholder? So let me just throw this question out there, because it's a big one. Can a company that's making more and more money actually be making its investors poorer? The answer, and this might surprise you, is a resounding yes. We're about to challenge that old idea that a big corporate savings account always equals more wealth for shareholders. So here's our game plan for today. We're going to start with something called the growth trap. Then we'll nail down exactly what retained earnings are. From there, we'll see why they're a real double-edged sword. And, this is the important part, how you can judge what's really going on. We'll even peek behind the curtain at the management trap before wrapping up with the core logic every investor needs to know. Okay, first up, the growth trap. It's so easy to look at a company's retained earnings number go up every year and think, wow, they're gearing up for something big. But this is where things can get really tricky. And here's the harsh reality of it. Just because a company is getting bigger doesn't mean it's getting better or more valuable. In fact, every single dollar that company decides to keep and reinvest could actually be chipping away at the real economic value of your investment. Scary, right? So to really get our heads around this trap, we've got to go back to square one. What in the world are we even talking about when we say retained earnings? The simplest way to think about it is as the company's giant cumulative savings account. In plain English, it's just the pile of all the profits the company has ever made in its entire history, minus all the dividends it's ever paid out. And here's the part you can't forget. That's your money. It belongs to the shareholders. Management is just borrowing it from you with the promise they can grow it better than you could. And the way it's calculated is just like a snowball rolling down a hill. You take what you had at the start of the year, you add in the new profits, and you take out any cash paid back to shareholders as dividends. What's left over rolls into the next year, and the snowball just keeps getting bigger. So you've got this giant, growing snowball of cash. Sounds awesome, doesn't it? Well, not so fast, because that cash itself isn't good or bad. What matters, and what matters immensely, is what management does with it. It can either be a rocket engine for compounding your wealth, or it can be a black hole that just gobbles up value. Let's break down those two paths. On one side, you have the compounding machine. Think of a company like early Amazon, pouring every cent back into the business and creating unbelievable value. On the other side, you've got the black hole. This is where that cash gets wasted on dumb acquisitions or inefficient projects, where every dollar they keep actually makes you, the owner, poorer. Okay, so that's the big question, right? How can we, sitting here as investors, tell the difference? How do we spot the value creators and avoid the value destroyers? Luckily, there's a pretty straightforward litmus test, and it just comes down to two little numbers. The first number is called ROIC, or Return on Invested Capital. All this tells you is how good the company is at its job. For every dollar of capital they have tied up in the business, how much profit are they actually generating? It's basically the company's report card on efficiency. And the second number is WACC, the weighted average cost of capital. Now, that sounds way more complicated than it is. Just think of it as the company's hurdle rate. It's the minimum return it has to earn just to keep its investors, that's both shareholders and bondholders, happy. It's the price of their money. And when you put those two numbers together, you get the magic formula. It is this simple. If the company's return, its ROIC, is higher than its cost of money, its WACC, it is creating value. Cha-ching. But if its return is less than its cost, it is actively destroying your money. It doesn't matter how much growth you see on the income statement. Let's make this crystal clear. Look at company A. It costs them 8% to get capital, but they're earning a fantastic 15% on it. Every dollar they reinvest creates 7 cents of pure value. Now look at company B. Same 8% cost of capital, but they're only earning a measly 4%. They're a value shredder. They lose 4 cents of your money for every single dollar they reinvest. Now, this all seems so logical, doesn't it? Earn more on your money than it costs you. So why on earth would any manager drive their company into that value destruction ditch? Well, the answer often lies in some very human and very powerful incentives. And that answer, more often than you think, boils down to a very simple, very dangerous motivation: empire building. See, here's the dirty little secret of the corporate world. A lot of the time, CEO pay isn't tied to how efficiently they run the business, it's tied to how big the business is. You get paid more to manage a $10 billion company than a $5 billion one, even if the bigger company is a financial mess. This creates this terrible incentive to just grow for the sake of growing, to get bigger, not better, even if it burns through shareholder cash. Okay, so let's pull all of this together. What does this mean for us as regular investors trying to make smart decisions? It really boils down to a fundamental change in how we look at companies. We have to stop asking the old, basic question, how much profit did they make? We have to start asking the much smarter question, how efficiently did they make that profit? For every dollar of our money they held on to, how many dollars of actual value did they create in return? And I love this quote because it cuts right to the chase. Investing isn't about feelings. It's not about getting excited that a company is growing. It's about the cold, hard math of efficiency. Is our capital being put to its absolute best use? So the next time you're flipping through a financial report and you see that big, juicy, retained earnings number, don't just smile and move on. Dig in and ask yourself the most important question of all. Is that pile of cash rocket fuel for my investment? Or is it just paying for management's very expensive lunch at my expense?